If you're feeling disoriented at this moment, know that you're not in this alone. Should you feel as though the financial markets are attempting to induce cardiac arrest, your perception is accurate. Just observe the events of the past 48 hours. On Wednesday, which was New Year's Eve, the valuation of silver experienced a sharp decline, plummeting by 8% to reach $70.50. The prevailing sentiment was one of utter desolation, with widespread selling and declarations that the bull market had concluded. Then, today, Friday, January 2nd, the market commenced trading and silver surged upwards, currently trading at $73.83, marking an increase of over 3% within a single trading session. In the blink of an eye, half of that precipitous fall has been recouped. If you liquidated your holdings on Wednesday, you're undoubtedly experiencing profound disappointment, having sold at the absolute low. Conversely, if you purchased at the breakout point on Monday, you remain in an unfavorable position. The market is exhibiting extreme fluctuations, akin to a toppled power line, indiscriminately impacting both optimistic and pessimistic traders. It decimated the bears on Monday, then devastated the bulls on Wednesday, and today it is again targeting the bears. It is crucial to understand that this is not indicative of a trend. Rather, it is a deliberate maneuver, a trap meticulously designed to maximize investor distress and to provoke doubt in one's own judgment, compelling them to abandon their positions. In the professional trading sphere, this phenomenon is referred to as a meat grinder, an environment that effectively disintegrates any trader foolish enough to employ leverage. In this urgent market assessment, we will deconstruct the mechanics of this extreme volatility. We will elucidate the strategic reasons behind the bank's orchestration of these price swings, designed to clear the playing field before the commencement of the genuine market movement. We will examine the critical threshold of $70 acting as a floor and the $75 mark serving as a ceiling. We are presently ensnared in a conflict zone between these two price points. My objective is to equip you with a strategy to navigate these turbulent conditions, because attempting to actively trade within this environment will invariably lead to losses. However, by comprehending the underlying causes of these movements, you can transform this volatility into a strategic advantage. While the price is in rapid motion, its directional progress remains stalled, a pursuit of liquidity. This is the narrative of the trap. To grasp its intricacies, one must delve into the psychological drivers of these market swings. Why did the market crash on Wednesday? As previously discussed, it was due to the global systemically important bank, GSIB, regulatory requirements necessitating liquidity for the banks. Why are we experiencing a rally today? The immediate selling pressure has subsided, the calendar has advanced into January, the banks have ceased their selling activities, and natural buyers have re-entered the market. Nevertheless, observe the confined trading range. We descended from $75, rallied to $73.80, and remain within the confines of this price bracket. We have neither achieved new highs nor fallen to new lows. We are confined within a stalemate. This intermediate zone is a predatory area where sophisticated algorithms capitalize on the actions of retail traders. When the price rises by 3% today, retail traders often experience fear of missing out, FOMO, believing it's a recovery, and feeling compelled to buy, often at $73.80. Subsequently, if the price declines tomorrow, they may succumb to panic and sell. The market is actively cleansing the order book, expelling weaker participants from both sides. The banks aim for a clean slate for the year 2026, ensuring no leveraged positions pose a threat. Consequently, they aggressively shake the market, driving prices up by $3, then down by $6, then up by $2 until positions are forcibly exited. This elevated volatility serves as a penalty for impatience. If you are constantly monitoring the charts, you are incurring this penalty, allowing your emotions to be exploited by sophisticated computational systems. The sole pathway to success lies in abstaining from short-term trading strategies. Let us briefly consider gold. Gold is currently trading at $4,363, having appreciated by nearly $40 today. Gold represents stability, while silver is exhibiting erratic behavior, experiencing an 8% decline followed by a 3% ascent. Gold remains steadfast, maintaining its support level and is gradually progressing upwards. This indicates that the overarching macroeconomic trend remains secure and the inflation and safe haven trades are still viable. Had gold experienced a $500 drop, it would be a cause for concern. However, gold is merely consolidating near its historical peak values. This suggests that the current turbulence in silver is specific to the metal itself, exacerbated by the reduced liquidity during the holiday period. It's important to remember that a significant number of traders are still on vacation. In low-volume environments, it is considerably easier to manipulate price movements. A single purchase order can drive the price up by $2, and a single sale order can achieve the same decrease. We are operating in an environment of low fidelity where the signal is obscured by noise. It is imperative not to misinterpret this noise as a shift in the underlying trend. Now let us address the short squeeze narrative. On Monday, the prevailing belief was that a short squeeze was imminent. On Wednesday, that sentiment shifted, with many concluding the squeeze had failed. Today, the perception is that the squeeze is back on. The reality is that a true short squeeze has not yet materialized. A genuine short squeeze, similar to the nickel situation in 2022, does not typically involve periods of decline. Rather, it experiences continuous upward momentum until exchange trading is suspended. What we are currently observing is strategic positioning. The major market participants are engaged in a territorial dispute. The bulls are fortifying their positions at $70, while the bears are constructing defenses at $75. This is akin to trench warfare, where the front lines advance and retreat by mere inches daily, with substantial financial losses incurred over minor price fluctuations around $73. Eventually, one side will deplete its resources. We must anticipate a breakout. Acquiring positions in the mid-range area is equivalent to gambling, akin to a coin toss. Will the price ascend to $75? Possibly. Will it revert to $70? Also possible. Savvy investors are adopting a patient approach, awaiting a clear directional signal from the market. Let us revisit the January effect. Today marks January 2nd, the initial trading day. We are witnessing buying activity, which is a positive indicator, suggesting that pension funds are cautiously entering the market. However, are they fully committed? Unlikely. They too are observing the prevailing volatility. A prudent fund manager would not invest $1 billion in silver on a day characterized by such extreme market swings. They tend to implement their investments gradually, utilizing limit orders. For instance, they might stipulate a purchase price of $72 and refuse to exceed $74. This passive accumulation creates a foundation of support, but does not fuel a rapid ascent. It establishes a floor. Consequently, the price might move sideways for a period as these substantial funds acquire their positions. Their objective is not to artificially inflate the price, but to purchase at favorable levels. They are the entities absorbing the market's fluctuations and catching what is commonly termed falling knives. Your strategy should be to follow in their footsteps. We must reiterate the inherent dangers of leverage. This point cannot be sufficiently emphasized. If you purchased a futures contract on Monday at $80 and the price subsequently declined to $70 on Wednesday, you would have received a margin call and been liquidated, resulting in the loss of your capital. Today, the price has recovered. Had you maintained your position, you would be witnessing a recovery. However, the leverage employed prevented you from holding, leading to your financial detriment. This market is actively targeting leverage positions, specifically individuals who are borrowing funds for trading. If you are trading with your own capital, you are largely insulated. $70 is merely a numerical value, as is $73. Your physical holdings remain secure. However, if you are trading on margin, these price fluctuations can be catastrophic. The banks are acutely aware of this dynamic and are deliberately creating instability to identify susceptible participants. If you react, you have become a target. Therefore, as we approach the market close today, refrain from excessive celebration. While the upward movement is positive, we have not yet fully emerged from this volatile phase. We are still within the ghost week period. Monday will witness the return of substantial trading volume, signifying the arrival of experienced market participants. Until then, We are operating within the domain of algorithmic trading, where these systems are engaged in a game of capturing your capital. In the subsequent segment, we will delve into the technical indicators. We will precisely delineate the locations of potential pitfalls and examine why the $70 support level is paramount and must be defended at all costs. We will also analyze the $75 resistance level. The conflict is defined by these two boundaries. Anything occurring between them is considered extraneous noise. Maintain your focus. The prevailing volatility is a test. Let us determine if we can successfully navigate it. We must first define the operational theater. In warfare, there exists a no man's land, an area between opposing trenches where survival is improbable. In the current silver market, this no man's land is the price zone between $70 and $75. Engaging in trading within this zone exposes you to fire from both flanks. The bears are launching attacks from the $75 level, selling on every price increase. The bulls are counterattacking from the $70 mark, purchasing on every price dip. And you, the retail investor, are caught in the crossfire, attempting to evade the ensuing detonations. In the second part of this analysis, we will map out the kill box. I will reveal the specific technical levels that the algorithms are defending. We will explore the concept of a liquidity sweep and explain why the price had to decline to $70.50 on Wednesday to generate sufficient fuel for today's rally. Furthermore, we will re-examine the disconnect between the physical and paper markets. While the paper price is experiencing dramatic swings, the physical dealers are maintaining a remarkably different stance, holding their ground. The chart may appear chaotic, but the underlying message is one of consolidation. Let us examine the price levels. Why did the price find support at $70.50 rather than $68 or $65? Because $70 represents the new structural floor for the global silver market. Recall that in November, $70 served as a ceiling, a resistance level that capped prices for weeks. Upon breaching this level, it transitioned into a floor. This exemplifies the polarity principle. The market must test this floor to ascertain its capacity to withstand pressure. Wednesday's price action constituted a stress test. The banks exerted significant downward pressure, attempting to breach this floor, but it remained intact. This indicates a substantial concentration of limit buy orders situated at $70. These are not the orders of retail investors who tend to panic sell at such levels. Instead, these are institutional orders originating from pension funds, industrial hedging entities, and sovereign wealth funds. They have unequivocally established a boundary. We will acquire any silver at $70. This provides investors with a considerable advantage, as the safety net is clearly defined. If you purchase at $73, your potential risk is limited to $3, knowing that the floor is at $70. Should this support level be breached, the underlying thesis would be invalidated. However, as long as $70 holds, the path of least resistance points upwards. The market has demonstrably shown that there are more buyers at $70 than sellers, which is the very definition of a bullish market. Now let us address the reasons behind the crash. It was not solely attributable to GSIB regulations, it was also a calculated liquidity sweep. Market movements are fundamentally driven by liquidity. If a large investor, often referred to as a whale, wishes to acquire $100 million worth of silver, they cannot simply execute the purchase at the prevailing market price due to insufficient sellers. Attempting to do so would artificially inflate the price, resulting in an unfavorable entry point. Consequently, they must locate sellers. Where are these sellers situated? They are typically positioned behind their stop-loss orders. Thousands of traders had placed stop-loss orders around $72. The whale and the associated algorithms are aware of this. Therefore, the market actively seeks out these stops, pushing the price down to $72, then $71, and ultimately to $70.50. At this juncture, the stop-loss orders are triggered, forcing retail traders to sell. This influx of liquidity floods the market, and who is present to absorb it? The whale. The price collapse was a strategic mechanism to generate the necessary liquidity for the subsequent rally. The whale exploited your fear to fulfill their purchase order. Once their order was complete, The selling pressure evaporated and the price rebounded to $73 as the artificial selling had concluded. This is a ruthless and ethically questionable practice, but it is how the markets often function. The liquidity sweep has concluded and the necessary liquidity has been procured. The market is now lighter and poised for upward movement. While the paper price was engaged in these maneuvers, what transpired in the physical market? Did the price of a Silver Eagle coin drop to $70? Absolutely not. I monitored the premiums throughout yesterday. When the spot price reached $70.50, dealers actually increased their premiums. Why? Because they did not validate the price drop, recognizing it as a purely paper-driven event. However, they were unwilling to discount their inventory simply because an algorithm in New York was experiencing a tantrum. Consequently, the street price remained at $90. This is a significant indicator signifying a divergence between the physical and paper markets. The paper market is characterized by extreme volatility, with daily swings of 10%. The physical market, however, is stable, reflecting a pricing structure based on scarcity. If you are a holder of physical silver, it is advisable to disregard the spot price chart, as it is providing misleading information. Instead, consult dealer websites as they reflect the true value of your holdings, and that value did not diminish, it remained firm. Dealers are privy to insider information observing the flow of physical metal, and their actions communicate a clear message: we are not reducing our prices. Now let us examine the mining stocks. They are experiencing considerable challenges. Imagine attempting to value a mining company when the price of its product fluctuates by $8 within a 24-hour period. It is an insurmountable task for analysts to construct reliable models. Should Hecla be valued based on silver at $70 or $80? This uncertainty generates volatility in the equity markets. Investors inherently dislike uncertainty, leading them to divest from mining stocks. This is precisely why mining stocks are lagging behind the metal's performance today. Silver has appreciated by 3%, while the miners have seen gains of only 1 to 2%, reflecting their confusion. However, this confusion presents an opportunity. The fundamental assessment of these mining companies has shifted. Last year, the baseline assumption for silver was $25. Today, the most pessimistic scenario projects silver at $70. Consider this. At $70, these companies are generating substantial profits with operating margins of 60%. Consequently, the stock market is mispricing the associated risks, factoring in a collapse that is not materializing. Once the price stabilizes and volatility subsides, value investors will return to the mining sector. They will perform their due diligence and recognize the value proposition. For instance, a company with a price-to-earnings ratio of 4 will become an attractive acquisition. The mining stocks represent a coiled spring within another coiled spring. For those with the requisite patience, this sector currently offers the most profound value. Let us adopt a more technical perspective. Observe the daily candlestick formation for today, Friday. Yesterday's candle was a significant red bar, indicating a decline. Today's candle is green, but it is entirely contained within the range of yesterday's bar. Today's high is lower than yesterday's high, and today's low is higher than yesterday's low. In trading parlance, this is termed an inside bar, signifying market compression. The market is pausing to deliberate. It is analogous to a spring being compressed from both ends. Typically, an inside bar is followed by a pronounced movement in the direction of the breakout. If the high of the inside bar is breached on Monday, it signals a victory for the buyers and the existing trend will resume. Conversely, if the low is broken, it indicates a renewed test of the $70 support level. Therefore, Monday's trading activity is critical as it will determine the direction of the spring's release. Given the prevailing January effect setup, the probabilities favor an upward breakout. However, we must remain attentive to the chart signals. We are presently confined within a price range of $70 to $75, experiencing bounces off the boundaries of this range. It is inadvisable to attempt to anticipate the breakout. Wait for it to manifest. Consequently, the floor is established at $70, the ceiling at $75, and the dealers are maintaining a price around $90. We are entering the first weekend of the year. While the financial markets will be closed, the prevailing anxiety is likely to remain elevated. In the third segment, we will examine the weekend outlook. We will discuss the geopolitical risks that could potentially cause a significant price gap at the market's opening on Sunday evening. We will revisit the gold signal, analyzing why gold's retention of the $4,360 level is pivotal for silver's stability. Furthermore, we will consider the volume profile for the upcoming week, assessing the magnitude of capital influx from institutional investors when they return on Monday. The trap has been meticulously set, liquidity has been harvested, and now we await the inevitable explosion. Please remain tuned for part 3. We are now looking ahead to the coming week. We must address the weekend period. It is Friday afternoon, and the closing bell for the trading day is fast approaching. The market is about to suspend operations for a period of 48 hours. Typically, weekends are occasions for relaxation. However, in a market exhibiting such extreme volatility, with movements of 8% downward and 3% upward, the weekend inherently poses a risk factor, commonly referred to as gap risk. While the financial markets are inactive, global events continue to unfold. Geopolitical developments, conflicts, and currency devaluations can occur. If a significant news event emerges on Saturday and the market opens on Sunday evening, the price will not likely be at $73. It could surge to $78 or plummet to $68, gapping to reflect the new reality. In the third segment, we will analyze the gold signal and examine the volume profile for the upcoming week, as next week, the first full week of January, marks the return of substantial capital from vacation. The $50 billion we previously discussed has not yet entered the market. The trap has been laid, the spring is loaded, and we are poised to observe its trajectory. I urge you to direct your attention to gold. Gold is currently trading at $4,363, representing a gain of nearly 1% today. Why is this observation significant for silver? Because gold is considered the leading indicator, the general, and silver, the soldier, tends to follow its lead. On Wednesday, when silver experienced its dramatic decline, gold also dipped. However, gold did not breach its structural integrity, successfully defending its key support levels. This outcome validates the overarching macroeconomic thesis. The significant capital, including central banks and sovereign entities, is not divesting from gold. Rather, they are capitalizing on the price dip. If informed investors are accumulating gold, it suggests that the silver crash was a deceptive maneuver, a derivative event rather than a fundamental monetary shift. Silver's inherent volatility causes it to overreact. When gold experiences a minor setback, silver can become severely afflicted. However, when gold recovers, silver is positioned for substantial growth. Currently, gold is demonstrating resilience, consolidating near its all-time highs. This acts as a gravitational force for silver. The gold-to-silver ratio currently stands at approximately 59. Historically, during a bull market, this ratio tends to decline towards 30. For this to occur, silver must appreciate at twice the pace of gold. Therefore, if gold remains stable, silver has a clear mandate to experience a significant surge. Monitor gold throughout the weekend. As long as it maintains its position above $4,300, the silver bull market is considered secure. Now let us turn our attention to next week, specifically Monday, January 5th. This will be the first truly active trading day of the year. The preceding week was a holiday period during which many senior traders were on leave and office occupancy was reduced. The trading volume observed today represents only the initial wave of participants. On Monday, the primary influx of market participants will arrive. Senior portfolio managers will resume their duties, investment committees will convene to finalize their first quarter allocations, and algorithmic trading programs will be fully activated. This confluence of events will lead to a substantial increase in trading volume. When trading volume rises in a constrained market, volatility tends to escalate. The liquidity vacuum experienced this week will be filled by institutional orders. These orders are of considerable magnitude, and their objective is not to profit from minor price fluctuations, but to establish long-term positions. This institutional investment is characterized by its persistence. Pension funds, for instance, do not liquidate their holdings the following day. They maintain them. This effectively removes a portion of the market's float permanently. Consequently, next week will reveal the market's true underlying strength. If we witness both high volume and rising prices, it will corroborate the January effect and confirm that the recent price decline was merely an opportune moment for major investors to acquire assets at discounted prices. We must also acknowledge the broader global landscape. While we focus on market charts, geopolitical tensions are escalating in regions such as the Middle East and the South China Sea. Shipping routes in the Red Sea remain under threat, and supply chains are demonstrating fragility. Silver is classified as a strategic metal, essential in the manufacturing of missiles and satellites. Should a conflict intensify over the weekend, the military demand for silver would become the paramount consideration. We previously discussed the Defense Production Act in our detailed analysis. This potential threat remains a constant underlying factor. Informed investors often hold silver as a hedge against geopolitical instability. They recognize that in the event of armed conflict, paper assets tend to depreciate while tangible assets appreciate. Entering the weekend with a substantial cash position carries inherent risk, as it signifies a bet on peace. Conversely, holding silver positions entering the weekend is a prudent strategy, representing a bet on potential chaos. Given the current global news cycle, chaos appears to be the more probable outcome. I must issue a caution regarding today's market close. It is Friday afternoon, and the banks may attempt one final deceptive tactic. They might endeavor to artificially depress the price in the final moments of trading to present a weak weekly chart, possibly printing a doji or shooting star candlestick pattern to discourage technical traders. Therefore, if you observe a sudden price decline within the last 15 minutes of trading, do not be alarmed. It is a form of market manipulation, essentially window dressing in reverse. Their objective is to create a visually unfavorable chart to facilitate cheaper purchases on Monday. Savvy traders disregard the final 15 minutes of trading during a holiday week. They focus on the body of the candlestick, not its wick. And the body of the candlestick clearly indicates that trading is occurring well above $70, demonstrating underlying strength. Let us conduct one final check of the physical market. While the paper price is experiencing wild fluctuations, the physical metal is disappearing at an accelerated rate. Reports indicate record withdrawals from the Shanghai Gold Exchange, signifying China's direct acquisition of the metal, not for speculative trading, but for physical possession. This depletion of physical reserves imposes a time constraint on manipulative practices. The banks can only artificially suppress the paper price for as long as they have a sufficient quantity of physical metal to support such actions. Once their vaults are depleted, the paper market game will conclude. We are progressively approaching that juncture. With each price dip, China increases its purchases and the rate of vault depletion accelerates. The predicament the financial institutions have crafted for you is in fact a snare they themselves are caught within. They are liquidating their lifeline vessels to acquire seating on a sinking vessel. Consequently, we possess gold reserves. The primary offensive commences on Monday. Furthermore, China is depleting its reserves. The circumstances are ideal, yet the most formidable hurdle is psychological. How can one remain steadfast when one's portfolio fluctuates by 10% in a single day? How does one find slumber when the media proclaims it a speculative bubble? How does one suppress the impulse to divest prematurely? In the fourth segment, the concluding installment of this discourse, I shall equip you with the psychological fortitude. I shall instruct you on emulating the strategies of major market participants. I shall furnish you with the projected divestment points for the year 2026, thereby eliminating the need for conjecture. And I shall conclude with my definitive judgment on why this perceived adversity has proven to be our greatest advantage. The market turbulence is nearing its conclusion. The upward trajectory is poised to resume. Remain attentive for the fourth installment. We are discerning tranquility amidst the pandemonium. We have arrived at the final chapter of this market advisory. We have successfully navigated the downturn of New Year's Eve. We have scrutinized the rebound on the 2nd of January. We have revealed the stratagem, the liquidity absorption, and the tangible divergence from paper assets. Presently, you are left with an investment portfolio that has weathered the most tumultuous week of the year. However, mere endurance is insufficient. Your objective is prosperity. To flourish in a market that experiences swings of 8% within a single day, one requires more than mere charts. One necessitates psychological resilience. In this ultimate elucidation, the fourth segment, I shall impart the perspective of sophisticated investors. I shall elucidate how the world's most influential financiers perceive market volatility not as a peril, but as a potent instrument. I shall delineate the divestment targets for the year 2026, providing you with a concrete strategy for when speculative fervor intensifies. And I shall conclude with my definitive assessment on why this week's engineered downturn was in reality the catalyst for the remainder of the year. The financial institutions endeavored to dislodge you. They were unsuccessful. Now let us ensure they bear the cost. Let us conclude this endeavor. How does an individual with $1 billion engage with the silver market? Do they intently watch the 1-minute chart? No. Do they experience panic when the price depreciates by $2? No. They leverage temporal arbitrage. The individual investor operates on a timescale of minutes or hours. The major market player operates on a timescale of years. The major market player understands that the fundamental shortfall in silver supply cannot be rectified in a single day. It necessitates a decade to establish a new mining operation. Therefore, the major market player acquires the asset today, cognizant that within 3 years, the scarcity will be severe. They are engaging in temporal arbitrage, purchasing from those who lack patience presently, with the intention of selling to those in dire need tomorrow. This week, we observed the impatient individuals divesting. They sold at $70, fearing the daily fluctuations. The major market players acquired at $70, contemplating the decade-long trend. You must adopt this mindset. Cease questioning the immediate future of silver. Begin inquiring about silver's standing when a major conglomerate exhausts its supply of a key component. Consider silver's position when the United States national debt escalates to $40 trillion. By extending your temporal perspective, market volatility dissipates. A downturn transforms into a mere ripple. A surge evolves into a sustained trend. Emulate the major market player. Engage in the protracted strategy. Now, let us address the divestment strategy. One does not acquire silver with the sole intention of perpetual ownership. It is acquired to preserve wealth until the financial system falters, at which point it is exchanged for tangible assets. Therefore, what are the projected targets for the year 2026? Target 1, $85. This represents the technical breakout threshold. Once we surmount the resistance levels of 50 and 80, which are all-time highs, the chart becomes unobstructed. $85 signifies the validation of a new market paradigm. At this valuation, your course of action is inaction. You maintain your holdings, allowing momentum to accumulate. Target 2, $100. This marks a significant media event. When we reach triple-digit figures, the global reaction will be extreme. This is when acquaintances will contact you. This is when the frenzy will commence. At $100, you might contemplate reclaiming your initial capital if immediate funds are required. However, the prudent approach is to await the ratio. The ratio target is 30-1. We have previously discussed this, but it warrants reiteration. Do not exchange silver for fiat currency, exchange it for gold. When the gold to silver ratio reaches 30, divest a portion of your silver holdings in favor of gold. When it reaches 15, exchange all of it. This methodology safeguards you from premature divestment. It compels you to remain invested until silver achieves historical overvaluation relative to gold. Presently, at 60-1, silver remains historically undervalued. We have considerable progress ahead. The most significant risk you face in the year 2026 is not a market collapse. It is divesting too early. It is a premature exit. You have endured the protracted downturn. You have persevered through the period of consolidation. Now the rewards are beginning to manifest. If you divest at $75, you are consuming the appetizer and foregoing the main course. The substantial gains are realized during the third phase of a bull market, the speculative frenzy. We are merely on the cusp of this phase. The general public is beginning to recognize the opportunity. Institutional investors are also becoming aware. If you divest now, You are relinquishing your position to a pension fund. Do not do so. You have earned the right to experience this ascent to its zenith. Secure yourself, much like Ulysses. Disengage the sell command. Allow the market to accelerate exponentially. Therefore, here is the assessment of this turbulent week. It was a deliberate ploy. It was engineered to confiscate your holdings. It failed. The market has recuperated. The price has surpassed $73. The weekly candlestick exhibits strength. The monthly candlestick is historically significant. The yearly candlestick signals a supercycle. The financial institutions unleashed their most potent maneuver and the market remains resilient. This indicates that the intrinsic demand surpasses the manipulation efforts. Tangible assets possess greater strength than speculative holdings. As we approach the weekend, relax. Your positioning is optimal. You possess the asset that is diminishing in supply. You hold the currency of the future. Monday will usher in substantial trading volume. Monday will bring the primary cohort of investors. And Monday will likely witness increased prices.